I know this is hard for you, but winter is coming.
It is time to get ready for the upcoming recession, because you better believe it, the recession not only may be coming up, the recession is here. All right, guys, it's no secret, the recession is here. If you look at the stock market, if you look at the NASDAQ, the S&P, the Dow Jones, if you look at any of the major stock indexes, they are all in bear markets, meaning the value from its top all the way down to its bottom has gone down 20% or more. That is what constitutes a bear market, and we have achieved that in everything. We've achieved it in crypto, we've achieved it in the major indexes, we've definitely achieved it in a lot of the different stocks. We're shooting this video on June 22nd, and the first thing to note is that last week the Federal Reserve met. They chose to raise interest rates again, not only by 25 basis points, not only by 50 basis points, they chose to raise it
75 basis points. The Federal Reserve Open Market Committee raising the funds rate by 75 basis points to a new target range of 1.5 to 1.75%.
Guys, this is the biggest interest rate hike in over 20 years. This is a big deal. And this, in a way, shows the commitment that the Federal Reserve has to fighting inflation. But this fighting of inflation is what is currently causing the recession. Let's talk about how this kind of trickles down to you, the average everyday real estate investor. And so two things to know is that we have two different kinds of inflation. Number one is we have asset inflation, also called
there's a bubble.
And the second thing we have is price inflation. This is when you or me, we go to Chipotle, we go to the grocery store, whatever you guys have on the West Coast, we go to a grocery store and we're paying more than ever. That is consumer price inflation. Now, we obviously know that asset inflation has gone skyrocketing. That's when people have made so much money in crypto and stocks and real estate and all these different things. And we also know that price inflation has absolutely skyrocketed. The government tells us, well, not all-time highs, but we're at 50-year highs at 8.3% a year. That's BS, man. We are way higher than 8.3%. And that's why the Federal Reserve is taking such massive action. Because what happens, Ray Dalio has a great video on this. I'll link it in the below, but it's about debt cycles. It's a really powerful 30-minute watch you should see. If interest rates are cheaper, I'll borrow more money, right? I'll borrow more money and I'll hire a company to put a pool in my backyard. When I hire a company to put a pool in my backyard, then all the employees there make more money. When they make more money, they're eligible to go out and they're eligible to get more loans. So when I make more money and I borrow more money and pay somebody else, they're gonna have more money, they're gonna be able to borrow more money, and it's gonna be this cycle that continues. And that's how things go up in value, because there's more and more demand. Well, as interest rates go up, I'm not as willing to pay the company to put a pool in my backyard because I was gonna borrow money for it, and now a pool's too expensive in terms of interest rates, so I'm laying that off. And now the pool company, their income goes down. And so what's gonna happen is that people are gonna start to spend less money. Bigger companies are gonna pull out of these alternative asset classes and go back to buying bonds where they can earn that 4% return. All this is going to cause a recession. And what does that mean for real estate investors, for stock investors, for crypto investors? What does that mean for investors in general? Now, I'm gonna talk to you about 3 things that you can do today to get ready for the upcoming recession. Number 1, immediately, and I literally mean immediately, like pause this video right now, go do this, get rid of all of your short-term debt. So if you're somebody who didn't take the advice that's in Skip to Flip, and you're out there flipping a house on, high leverage, short-term debt, whether you borrowed money, for 12 months, 18 months, 24 months, whatever it is, and you have to sell that property, you need to immediately get rid of the debt that's attached to that. Now, you may not want to sell that asset. You can. I would advise if your business plan is to sell that house, to sell whatever it is attached to that short-term debt, sell it. But you don't want to be in a position in 6 months from today where that debt comes due, you don't have the cash, there's no buyer for the house, and nobody is lending you money. That's the position you do not want to be in. That's the position a lot of people were in 2008 that caused it to be so bad, and that's what caused people to get wiped out. Right now, today, with confidence, I can tell you this upcoming recession is not going to impact any of my properties, because what is going to happen is that I don't have any debt due for, I think, the next 4 years. I don't have any debt due for the next 4 years, okay? So if you have debt that's due in the next year, 6 months, really less than a year, I would say 2 years, you need to redo that loan. You need to go get another loan. I don't care if you have to pay higher interest rates. You should go out and get longer term loans, 5 years minimum. That is the number one thing you can do. Get rid of short-term debt and short-term liabilities. I don't care how low the interest rate is. You're gonna have yourself a bigger problem off your hands if you can't go get new debt on that project when you need to. So while values are still high inside the real estate market, you need to go out and get new long-term debt on that. Number two, you need to double down on building skills that will produce more income. Right now, the Federal Reserve is raising interest rates because we have a strong economy, right? We have such a strong economy because the labor market is, I think they're calling it white hot, right? This white hot labor market with unemployment that's so low. Guess what? That's BS. Why? Because all the people over the last 2 years who should have gone out and gotten jobs have done things like start their own crypto project, been, a stock trader, or they're doing all these things that they've been able to make money at. Really productive people, right? Really productive, really smart people have been doing things that weren't economically viable over the long run, but in the short term, they can make money because we were in a bubble. Now, all of those people are gonna have to go back to work. All the companies out there who are trying to hire people, can't find any good people. People right now are saying, well, there's so much money in the system, house prices are so much, debt is so cheap, I don't need to go get a job, I'll try this out, I'll try that out. I think that the labor market is gonna turn around really, really quickly, and you need to be a high valued person who knows how to produce income for you and your family. The third thing that you need to do is cut out all unnecessary expenses, okay? So if you're, buying Louis Vuitton bags, if you're buying Gucci belts, if you're, going out to eat because you think you got so much money and you're spending $200 dinners, every weekend, if you got lavish vacations planned, listen guys, I would not go out and I would not do that unless you feel comfortable with your sources of income, that they are recession resistant and that they are not gonna be evaporating. If you're living on money that you have in the bank that is not a renewable source of income, I would not be spending that money. I would be cutting down on all unnecessary expenses because I think that you're gonna want that cash. I don't think that the Federal Reserve is gonna be able to raise interest rates high enough to actually combat the inflation we have. I think that we're gonna have more of a stagflation period, okay? Where the economy really slows down, but inflation still really runs rampant. And so I wanna cut over real quick to what Warren Buffett has to say about investing in times of inflation. Watch this video.
In some of your earlier letters to shareholders, you warned about the dangers of inflation and cautioned that shareholders should fully take inflation into account when evaluating the performance of a business. To what degree do you expect a large decline in the value of the dollar to trigger inflation that would adversely impact Berkshire's equity holdings and its businesses? And to what extent should we calibrate Berkshire's overall performance against the backdrop of a weakening dollar?
Well, we think, by and large, we have businesses that will do pretty well in inflation. But inflation destroys value, but it destroys it very unequally. The best business to have during inflation is one that retains its earning power in real dollars without commensurate investment to, in effect, fund the inflation produced nominal growth. The worst kind of business is where you have to keep putting more and more money in to a lousy business.
That was a lot of lingo there, right? What did he just say? He said the best investments to have in times of inflation are investments that produce real growth in real dollars, meaning after you account for inflation, that they're gonna be there without having to pour more money into the investment. So what does that mean for real estate investors? Does this mean we shouldn't be investing? No, this means we should stick to the plan because I think inflation is still gonna be a problem. I think you're still gonna wanna be buying good properties in good markets with multiple tenants with long-term debt. I don't care about the value. Guys, you need to go out and you need to be buying properties that you can get long-term debt on, that have steady income, that are in solid markets, but most importantly, that are going to help you for the purchasing power you do have today. If you have 50 grand, 100 grand, however much money you have sitting in the bank, you're gonna wanna get that money out of your bank. You're gonna wanna get it into investments. Doesn't matter what happens with the value. Pay attention to cash flow, pay attention to recession resistant, and pay attention to inflation resistant. What does that mean? Storage units, multifamily housing, industrial buildings, logistical centers, all the things that people will need no matter what happens, those are the types of properties you need to be paying attention to right now. So with all that being said, guys, don't worry about the recession. Don't stress about it. Don't panic about it, because I don't think it's just gonna be this sharp crash. I think there's a lot of money out there. I do think inflation will be a problem. I don't think we can raise interest rates to a level where our government can actually service their debt. If we get interest rates up to 10, 12, 15, 18% like we had back when recession 50 years ago was at its worst, then guess what? We can't make it. Our government can't make it. So it's gonna be really interesting to watch what happens, but these 3 tips apply. Number 1, immediately get out of short-term debt. Number 2, double down on skills that build income. And number 3, cut all unnecessary expenses. With that being said, I hope you guys liked this video. I hope it was impactful. Shoot me a like, hit the subscribe button. I'll see you next time.